Are you like most real estate investors where you're using one loan to buy one investment property? Maybe your bank has told you you've maxed out because your DTI is too high. Have you ever thought about using a DSCR loan and potentially doing a portfolio or a blanket loan? So guys, in this episode, I'm going to talk about DSCR loans, how you can use a blanket or a portfolio option, but better yet, we can get creative enough to where the only entry point for you is your personal credit score, and that's it. So let's get into it, guys. So how can you think bigger with DSCR loans? DSCR loans do not impact your debt to income ratio. They are not reported on your credit bureau. If someone told you, they are incorrect. And oh, by the way, you can close these loans in an LLC. Why close them in your personal name when you can close them in the LLC? One caveat there, guys. In this video and in this episode, I will share the pros and cons because there's not all roses with DSCR loans. There's a con with this. If you do close in a you close a DSCR loan in your business name, an LLC, you will have to personally guarantee it. They are not going to allow the company to guarantee it itself. They want one of the officers to actually guarantee it. So God forbid, if something does happen, you're personally guaranteeing that actual loan. So DSCR loans are not they're not just for one-off investment properties. You can buy portfolios. So let's talk about a portfolio. Let's say you want to buy 10 or 15 doors at a time. You don't want to get 10 or 15 loans. They can do a portfolio loan, which would cover all of that. The other piece of it is this. Investors think that you cannot scale with DSCR loans. You can. The caveat is it is going to still require between 10 and 20% down of the actual purchase. We can't get around that. That's a downside. Can you get creative and find a way to have a partner come in with the down payment for you? Sure. But you will have to source that income, especially if you're buying 6, 8, 10 doors. You're talking tens of thousands of dollars. Anything above $10,000, the lender is going to want you to source the funds. They're going to want to know where they came from. So 2 things that can happen here. 1, this person can be part of your LLC or your management team, so you can bring them in, or you can share with the lender where the funds came from. More than likely, if you do that, they're going to pretty much shoot it down. So you need to find a creative way to bring that money into the door. There are some downsides. 5 years down the road, 6 years down the road, you decide that you want to sell 2 of the properties. That's going to be a problem because most portfolio/blanket loans, because they both have this problem, will actually have some type of penalty for you to actually pull these properties out of the portfolio loan. The reason why is because they will have to rewrite the deed. They will have to restructure the whole deal because now they're pulling properties out that were on one deed. And now they're saying, okay, that property or those properties are sold. Now they have to reconvey them and get them re-recorded again. So there is a downside. If you see yourself holding these for a major period of time to where you pay down a majority of the debt or practically bring it to zero, it potentially could work because these penalties that they will charge to sell these properties is anywhere on a low end of 5%, and I've seen a high end of 20%. So on $100,000, you could have 5,000 up to 20,000. So it's all going to depend on you and what you're looking at. In this process of blanket versus portfolio, the acquisition is really how it actually happens. Portfolio is the front end of the actual purchase, and then blanket is you're blanketing your actual portfolio. So you've already actually owned them and you potentially could be doing a cash out refi or a rate and term. So you're bringing them all in. So you're just basically going, the portfolio is going to be acquisition front end. Blanket is going to be a refi, whether it be cash out or just rate and term, where you're just getting a better rate and you're not taking any cash out. There also could be prepayment penalties on these. They could be anywhere between 1 year and 5 years. There's some legal complexities in all this. So make sure that when you're looking at this, understand what they are. And I can't tell you exactly how those are going to play out because each lender is different, but review your paperwork. One of the biggest mistakes we can make as investors is not reviewing the closing paperwork. I know there's 100 pages. Ask for the documents up front so it gives you time to be able to review them. Because if you can't review them, why are you signing them? You don't know what you're signing. And you sign something you don't know about, it's going to come back and bite you in the butt. And you don't need to do that. You can also cross-collateralize with DSCR loans when you do a blanket. Let's say you've got 5 properties that have a high amount of equity. You want to use that equity to go out and secure 2 or 3 other properties. You can blanket those and you can actually pull the equity out, a cash out refi, take the equity, go buy the property. This is a great option if you're equity rich and you want to go out and acquire 3, 4, 5, 6 properties. It works very well. There's a downside, guys. Again, if properties tanks, rents go down and they stop cash flowing, it impacts your whole blanket loan. So be cautious of that. Make sure that you're looking at your DSCR ratios. Everybody says, oh yeah, you can get a DSCR ratio down to 0. Guess what? That means you're losing money. 1.25 to 1.35 is a really safe place for you to be to ensure that you can cover your mortgage payment, principal, interest, taxes, and insurance. You're putting money away for any type of repairs. All of those things add up. And let's say rents change, rents go down. Why are you going to want to continue to pay money out of your pocket to keep that rental afloat? So don't, 1, over leverage the property, and 2, don't overbuy to where your DSCR ratio gets down to 0 or 1 is just as bad because you're losing money there too. It's only covering your PITI at that point. So please do not fall into that trap. So the BRRRR method and DSCR combo, it can be done. I see it all day long. I work with investors that do it. They'll go out and get a hard money loan, bridge loan, however you want to call it. It's going to be more expensive, but it actually works. The one caveat I can tell you guys about hard money is make sure, again, you don't over leverage. Understand your purchase, understand your rehab costs, understand what the ARV is going to be after the property is rehabbed and ready to go, and know what it potentially can rent for, cash flow. Because ultimately, when you're going to pay off that hard money loan, you're only going to be able to do 2 things. 1, if you do a rate and term, they'll let you do up to 80%. If you're going to do cash out, it'll be between 70 and 75%. So if you're already at those percentages already in your deal, this combo will not work. I don't know how you would exit. You're over leveraged. So you'll have to figure out how to get yourself out of that hard money loan. Make sure that you keep it below 60%, because typically on these DSCR loans, there's anywhere between 6 and 8% in closing costs, sometimes more. So if you're at 60 and you can only get 70, then bada bing, bada boom, you're good. You're taken care of, you move on. But if you're leveraged up to 70 or 75% with your hard money loan, it isn't going to work, and it's going to put yourself in jeopardy, and you don't want to default. Closing with the right lender, guys. Make sure you're looking for a lender that understands portfolio, blanket loans, non-QM, which is non-qualified mortgages, and they've got experience in the DSCR space. You don't want to go to your local credit union or local bank. Typically, they understand the process, but they're going to make you qualify off of your personal income. They're going to ask for tax returns. They're going to ask for bank statements. They're going to ask for your W-2s, and they're going to hit your DTI, and it's going to fall on your personal credit. Ask the questions. Take time to vet out that lender. Figure out if they're the right person to do business with. You want to build that relationship over time. Good question to ask if they understand is, do they offer portfolio DSCR loans? Do they offer blanket DSCR loans? And have them explain what they offer and ask them, what does it impact you in the sense of credit? Do they only need to pull your credit score, or are they pulling your credit in putting this on your personal credit? Because some of these loan officers don't know the difference, and all they're trying to do is just run you an application, and bada bing, bada boom, you're in a trap and you can't get out of it. And then the last piece is probably one of the most critical, is how quickly can they close? Can they close in 2 to 3 weeks, or is it going to take them 4 to 6 weeks? By all means, guys, I've had deals that is taken 4 to 5 weeks, just for the simple fact there was problems with the appraisal. There was problems with underwriting. There's just files that happen that have issues. But if someone can tell you they can consistently close 2 to 3 weeks and tells you how that's going to happen, I place an outline together for my clients, letting them know all the documents up front that they need. We upload them to a Google Drive. And if we're not being supplied the information, I'll let them know. And really, once the docs start flowing, we can get this into the lender and get it moving as quickly as possible. But it really depends on you, the investor, to actually get the documents to us. Otherwise, I can't move. I can control certain things, but if you don't give the documents over, I cannot move. So it's a two-way street. Just make sure you're cognizant of that. Faith and mindset. I'm going to read this off as, scaling is good, but reckless scaling isn't wise. God didn't call you to build an empire at the cost of your peace. He called you to build with purpose. Growth should serve your mission, not become your master. That just resonated with me very well. It's like, we're in business to serve others. It's okay to make a profit, but serve others through that profit, through what you're doing. Provide the services that you're passionate about to other people that truly need them. So guys, if you like what I'm putting out, please share, please follow me. I'm trying to create a community here. I would love to be able to have further conversations around DSCR, small business ownership, financing, faith. All that is in play. I'm a very open book, and I like to have conversations with other like-minded folks. Just have to reach out, have a conversation. We'll figure out where it goes. But guys, if this helped you, please subscribe and share. Hope you guys are having a great day. Stay safe